Hi, my name is Lauren Templeton, and you are listening to Investing the Templeton Way. This podcast is for anyone interested in learning more about investing. In this podcast, I will be interviewing some of the greatest minds from the investment community and exploring topics ranging from international markets to behavioral finance. To learn more, please visit us at investingthetempletonway.com. The information presented in this podcast or available on the website is not intended as and shall not be construed as financial advice. This podcast is produced for entertainment value. Investing is inherently risky, and I encourage you to seek financial advice from a professional who is aware of the facts and circumstances of your individual situation. Thanks for listening. I just want to welcome my guest and say thank you for listening to the Investing the Templeton Way podcast, where we explore the world of investing through interviews with well-known investment professionals and academics. Today, we are trying something new, which I've already talked to my guest about. I have a guest host today, my husband, Scott Phillips. I think most of my listeners know that Scott and I work together. We run Templeton and Phillips Capital Management together. We co-authored the book, Investing the Templeton Way, and we work on various projects together, including raising two children. He heard who my guest was today and said, I really want to participate in this interview. And so I'm very excited to let my listeners know that my guest today is none other than Robert Hagstrom. So Mr. Hagstrom is Chief Investment Officer of Equity Compass and Senior Portfolio Manager of the Global Leaders Portfolio. Prior to joining Equity Compass, he was Chief Investment Strategist at Legg Mason, where he worked with legendary investor Bill Miller. Robert is the author of 10 investment books, including the New York Times bestseller, The Warren Buffett Way, which is widely considered to be the definitive book on the investment approach and strategies of Warren Buffett. The book has sold over 1 million copies worldwide and is translated into 17 foreign languages. In addition, Robert wrote Investing, The Last Liberal Art, a multidiscipline examination of investing and decision-making. And his latest book, which just published in 2021, is Warren Buffett, Inside the Ultimate Money Mind. So welcome, Robert Hagstrom.
Well, Lauren, it's great to be with you. Thank you.
Great. Well, I know I've listened to so many of your interviews. I'm a big fan of your work. And most of the interviews, you end up talking about Warren Buffett and his background. And we have plenty of time to jump into that. But before we do that, I want to ask about Robert Hagstrom. Can you tell me about your childhood, your background, what led you to the field of investing, and why in the world did you want to write a book on Warren Buffett?
Well, the story is kind of a happenstance. You turn left, you turn right, and had you not turned right, you might have not gotten into this business. I actually went to school. I was born and raised in Nashville, not too far from you guys.
Oh,
And
no
my
kidding.
parents, born and raised in Nashville. My parents were at Vanderbilt University, and they actually had their honeymoon. I think I told Amanda this. Their honeymoon was in Lookout Mountain, so that's a soft spot for me.
Wow. That is really a small world.
Yeah. So anyway, I went to Villanova University and did my undergraduate and graduate degree in political science. I had this idea, and I had done some writing in college for the local, student newspaper. And then I started writing for some of the smaller community newspapers around Philadelphia, interviewing politicians and things like that. So I always had it in mind to write. And I had gone to Washington. I really wasn't a big fan of Washington politics. I shouldn't have been so naive, but came back and asked the publisher, could I get a job writing a column? And he said, well, we can't afford to pay you, but if you go out and sell quarter-page ad newspaper ads for our paper, get some money, maybe we'll let you write a column once a month. So I went up and down the main line here outside of Philadelphia, banging on doors, asking people to buy an advertisement for the newspaper. And one day I went past something called Legg Mason Woodwalker, members of the New York Stock Exchange. I didn't know what it was. I thought maybe it was an accounting firm or a law firm. I had no idea. walked in and said, "Hey, can I speak to the manager?" And they took me back and said, "Hi, I'm Robert Hagstrom. I wanted to know if you might want to buy an ad for the newspaper." And the manager said, "No, would you like to sell stocks?"
Oh,
And I kind of stopped and I, thought to myself, well, this is unusual. And I went to training. In those days, we went to Baltimore, Maryland, the home office, and trained there for 3 weeks. And I had thought I'd made a terrible mistake, Lauren. I was not. I was a liberal arts major, and I didn't know much about finance and accounting. And all they did was look at value line investment surveys and talk about numbers and price earnings ratios, and it just wasn't clicking. But the night before we left, the Thursday night before the end of the third week, we were given a copy of the Berkshire Hathaway annual report, which I'd never heard of, written by a guy named Warren Buffett, which I had never heard of. And we were asked to read and come back the next day and discuss. And I got to the hotel room and opened up the annual report and was immediately depressed because it was 24 pages. Those shareholder reports are very long.
yes.
And, I sat down and it was the proverbial light bulb went on. Whereas what I was thinking about investing all from numbers, and they're important, no doubt. But what Warren was doing was talking to me about people and the management and the people that ran the companies, and was talking about the businesses and the products and services. And all of a sudden, that was the proverbial light bulb, which is, oh, all these numbers, they're actually businesses. And these businesses, I can understand. I can understand newspaper businesses and furniture stores like Nebraska Furniture Mart and things like that. And so my connection to investing really happened because Warren spoke to me in a way that resonated with me that I didn't get from simply looking at balance sheets and income statements. Now, later on, I understood balance sheets and income statements, but how I got started was, as Warren says, stocks are businesses. Think about a stock as a business. And when I conceptualized it that way, then I was off and running.
Yeah, that makes so much sense. I had such a similar, well, it's not a similar story, but when I was a young child, my dad would allow me to pick a stock per month, and he would hang the stock certificates on the walls in my room. And something about actually holding the stock certificate where it represented my ownership, it really allowed me to think of stocks as businesses. So that's, I grew up thinking of, well, I own a fraction of a business.
Yeah.
And it really impacted the way I thought about the markets. So we see things the same way. So how did you go from that to managing money with Bill Miller and eventually writing the book, The Warren Buffett Way?
Well, I was on the sell side at Legg Mason for about 5 years, and I did okay, but my manager came back to me one day and he said, "Robert, you could actually, double your income if you ever sell anything." And I said, "Well, that's not the way it works. If you find these really good businesses, you're just supposed to hang on to them, and we're not supposed to do a lot of trading." And so those were the days, Lauren, back in the early 80s, where you didn't have a fee-based business. All brokers were working on commission. So it was about activity. Activity was your income. So I knew I needed to get to the buy side. I went to a local bank and worked in the trust department, then joined a small investment advisory, got my CFA. And around 1992, the Institute of what's called the Association of Investment Management Research in those days came out with the performance presentation standards that said, if you're going to produce any performance, it has to be 100% discretionary. And we were kind of like a trust company. We let clients lean in on stocks if there was tax considerations or they had a favorite stock. We weren't a discretionary shop. And I said to my partners, look, if we're going to grow this business, we got to get a track record. And to do a track record, we need a 100% discretionary, kind of strategy. And they said, well, what do you want to do? And I said, well, I'm a big fan of this Warren Buffett stuff. And they really had it up to their ears with me talking about Buffett. And so I wrote a white paper, which was meant to be kind of a marketing piece for this new strategy, that fell into the hands of an agent who started to shop it. And, the first couple of people weren't too interested. They wanted a book by Warren Buffett, not about Warren Buffett. But finally, we landed at John Wiley, and my publisher then, Miles Thompson, who's still my publisher today after all that time, was willing to take a shot on a first-time investor. And so began writing the book. And the way that I thought about it, I'd read so much, in 83, 84, when I started, I went back and got all the original editions of the Berkshire Hathaway Annual Report. I had all the magazine articles, newspaper clippings. I was like a kid falling a wallpaper. So, after 10 years, I was pretty much up on the arc of how I was thinking about things. And he really kind of divides the world, Lauren, as you well know, into businesses, management. He looks at the financials and he thinks about valuation. And so I had business tenets. He talks about what was important. He had management tenets. Then we had the financial tenets that we had to think about, and then ultimately valuation, which was a dividend discount model, the old John Burr Williams. And I sent him a letter because I wanted to know that I was working on this book. And I sent the letter and I said, my name is Robert Hagstrom. You don't know me, but I am going to write a book about you. And I asked for permission to quote from the annual reports, because, Lauren, he's the only CEO that I know of that actually copyrights his annual reports.
Yeah,
So,
I knew
and,
that.
yeah. And so I wanted to have Warren speak through the book by using his quotations and explaining, the different business tenets. And I said, may I have your copyright permission? And I waited a couple of weeks. This is before email. And finally, a letter came back from Kiewit Plaza in Omaha, and I opened it up and it said, well, dear Robert, thank you so much for your kind letter. He goes, I can't give you copyright permission just yet. Well, being in sales, Lauren, we both know not just yet means, well, that's not a no. It's just, what do we got to do?
So you're saying I have a chance.
Yes, I have a chance. And so the deal was that I had to send him every chapter of the book, and then he would read it, because he had some unpleasant experiences with people that wanted to try to write books back then. There was one book that John Train wrote called The Money Masters that John Templeton was in.
In it.
Yeah,
Mm-hmm.
Phil Fisher, Ben Graham, Peter Lynch, and Warren Buffett. And then John Train, who very nice guy, but he kind of went off on a limb and wrote a book called The Midas Touch, where he wrote a book about Warren that really wasn't the kind of book that Warren wanted to have written. And so it really turned him off on it. So the deal was, okay, I got to send you each chapter. Debbie Bazanik, who is still his secretary to this day, I think she was 17 years old when she started working for him. She would call me and say, hey, it's fine, send the next chapter. And so we went through the whole book and sent all the chapters. And Miles Thompson, my publisher, was like, Robert, where's the copyright permission? I said, well, it's coming. It's getting here. And finally, the last chapter I sent, and Debbie said, you're fine. And I said, can I get a copyright permission? And he sent it on, and the book was published. So I'll give you this as a way of, once again, how lucky that I've been in life. The book came out, came out in 94, and we had just come out of the recession, 91, 92, and the markets weren't that great. Things weren't doing that very well. And so I think there was appetite for Warren. And when the book was published, the original first edition, this huge picture of Warren on the front cover, the Warren Buffett Way, Investment Strategies, the World's Greatest Investor. At the top was Forward by Peter Lynch. Well, that's great. Peter was the guy back then, so Peter wrote the forward. Off to the side was a quote from Forbes magazine. It was actually written by Fisher, Phil Fisher's son, who said, best book of the 1990s, buy it and read it, because I had spent a lot of time talking about his dad, Phil Fisher, and how important he was. And so when you kind of looked at this book, it was all ready to go. Here we had Warren Buffett, Peter Lynch, and Forbes saying, and at the very bottom in type that could have been a millimeter high was by Robert Hagstrom.
Oh.
So when people looked at the book, it had all the right parts, and they didn't emphasize me. And the book became a New York Times bestseller. And, we were off to the races after that.
Oh, well, I think they would put your name in bold these days. Philip Fisher's book was one of the first books I read about investing. What was it? Uncommon Stocks and what?
Uncommon Stocks and Common Profits.
Yeah, Uncommon Stocks and Common Profits. My dad gave me a copy of that, and it was one of the first books I read. Of course, I read all of Peter Lynch's too. Well, that's such an amazing story. When did you first, I'm assuming you've met Buffett on many occasions. When did you first meet him in person?
Yeah, well, I got Phil's book, Common Stocks and Uncommon Profits is what it's, that's a title. So I don't want any people to think I don't know Phil's book. I actually, so the book came out in 95, came out late 94 into 95, and I met him in New York at annual meeting. Basically what happened, I knew that he was coming to New York for the annual meeting for Cap Cities, and I called Debbie and said, I'm in Philadelphia, can I stop by and the annual meeting and maybe get a chance to meet him? And he said yes. And so after the annual meeting, I'm standing in the very back, and I don't even know how he knew it was me. I no pictures of me or anything like that. And there he comes walking down the middle of the aisle, And he says, Robert, so good to meet you. And I'm like, well, trying to get my words out. Mr. Buffett, great to meet you. And we talked about 5 or 10 minutes, and then he was off, and he said, listen, I want to see you at the Berkshire meeting next year. And I said, sure, I'll be there. And then, of course, in 96, I pretty much have done every one. I think I've only missed 3 or 4 for weddings or graduations and things like that.
Mm-hmm.
And we're not best buds or dinner partners, but we stay in touch. And what I try to do is just keep him up to date on what I'm working on. I don't spend a lot of time wasting his time with phone calls or lengthy emails. I just, this is what I'm doing, and keep him up to date. And he really liked the last book, because we talked about his dad, Howard Homan Buffett, and his influence on Warren, which nobody had done before. And there were some other tidbits that he really enjoyed. So, it's great. I mean, the trick is, as he said, and you well know, Lauren and Scott, is, pick your heroes. And if you pick the right heroes and you imitate what they do, you're probably going to be okay in life. And that's what I've done.
Oh, that's such good advice. Speaking of your new book, Warren Buffett, Inside the Ultimate Money Mind, and attending all the annual meetings, will you spend a moment telling my guest about the 2017 annual meeting when the money mind was first discussed? So I'm curious, What is the money mind, and why did you write your new book?
Well, it's interesting because somebody asked a question about the future allocation of Berkshire Hathaway, and what they were getting at was, at which point you and Charlie are not up on the stage, who's going to make these capital allocation decisions for Berkshire Hathaway? And Warren said right off the bat, he said, well, whoever is going to get this job has to have a money mind. I had never heard that word. He had never used it in the annual reports. I'd never heard it in speeches or sharing. And he said, a money mind is someone who understands the rational allocation of capital, how to think independently, and all. And he kind of went through these things. And it kind of dawned on me that what I had spent my life doing was trying, once again, going back to the numbers. I was all trying to figure out the dividend discount model and the intrinsic value and stuff like that. And I was getting all the factoids right, and we had that figured out. But I really didn't get into, the kind of the philosophical aspect of what it takes to be a good investor. So there are 2 parts, and you and Lauren, you and Scott know this, is you got to understand the numbers, but you also have to have this kind of money mind attitude towards the market to be able to dodge its missteps or not become seduced by it. And you almost live independently of the stock market. And that's what a money mind does. And so the idea of the book was to take the philosophical side of the argument, because we didn't talk a lot about philosophy in the Warren Buffett way or the Warren Buffett portfolio. It really was about the mechanics. And so what we did in the money mind was, all right, let's go back to the beginning, and we talked about his influences of his dad. We talked about rationality and all the influences that he had there. And of course, Charlie and things like that. And then we compare and contrast what a money mind differs from those who get their CFAs, which I have my CFA, and modern portfolio theory, how different that is. A money mind is how different that is from modern portfolio theory that's taught in business schools and things like that. So we had a lot of fun with it. And it was a different kind of book, but I think it was one that needed to be written to emphasize the philosophical aspect of investing, equal to, understanding the financial dividend discount models and things like that.
Yeah, so you're talking about temperament and really the behavioral side of investing, the human quality of investing, so to say. The money mind. And, I am reminded that when you're talking about modern portfolio theory and Markowitz and Sharpe and Fama, they're all really reliant on this idea of Homo economicus, which is man as a perfectly rational wealth maximizer. And I don't know a single man or woman who is perfectly rational, particularly when it comes to money. So we agree and think temperament is very important. What are some of the other qualities, either that you've learned from Warren Buffett or maybe you've learned from Bill Miller, but what are some of these, essential qualities to making good investment decisions?
Well, Bill's a separate entity of himself. He actually, there's an article that he wrote that he was interviewed in Forbes magazine in 1989 when he kind of pivoted from the low PE investing world to buying the better businesses. And he had been studying the Berkshire Hathaway annual reports and he called Warren the god of value. So But
Mm-hmm.
Bill went on to do some other things in technology land that Warren didn't do that we understood. But the big thing is, and we talked about it in the book, you talked about Markowitz and Fama and all this. So if you go back to Markowitz's original paper back, I think it was 1956, that ended up becoming his PhD dissertation. It wasn't, I think it was like 11, 12 pages, 3 or 4 different mathematical formulas and stuff like that. But he made a presumption. He made a presumption that at the time he felt that the way to think about risk and return, he had the return part right, which was the yield of the investment. But he all of a sudden said risk is the variance of returns. It had never been written
Mm-hmm.
that way. If you go back and read Graham and Security Analysis, and even An Intelligent Investor was written before Markowitz wrote his PhD dissertation, there was nothing about variance being risk.
Mm-hmm.
But Markowitz basically said, okay, risk is how bouncy something is. And so he talked about covariance and how you can tamp down prices. Now, what's interesting, if you go back to history, nobody paid attention to Markowitz or Fama until about 1974. So, almost 20 some odd years later, 18 years later. And what happened was the 73, 74 bear market was so traumatic. And,
Mm-hmm.
we cut money in half. There were reports, pension plans were underfunded. People weren't going to be able to get their retirement savings and stuff like that. And they looked around. We had just come out of a big growth period back then, Jerry Zai and the Manhattan Fund and stuff like that. And value hadn't done very well. The classic value hadn't done very well. The growth had all gotten blown up. And people were looking around and saying, well, what are we going to do now? How do we get back on our feet? And somebody
Mm-hmm.
grabbed a hold of Markowitz and said, what we got to do is we got to reduce volatility. So to reduce volatility, let's do this modern, what wasn't called modern portfolio theory then, but, do the covariance returns of broadly diversified portfolios will tampen down the volatility that people hate.
Mm-hmm.
So that's then how people began to think about risk as price volatility. But as you well know, Ben Graham and Warren Buffett do not think about price as being risk.
Right. John
Risk
Templeton did
is,
not either.
yeah, exactly right, Lauren, exactly right. It had nothing to do with price risk. It had everything to do with permanent capital market, permanent capital loss.
Mm-hmm.
And so what happened is that they then got a kind of stake in the ground in the late 70s. And when we had the great bull market that began in 1982, people just latched on to modern portfolio theory, Markowitz, broadly diversified portfolios, and high things that bounce a lot. High beta is more riskier than low beta and stuff like that. So everything became price centric,
Mm-hmm.
and that's where we are still today. To this day, people perceive that which goes up in price is good and that which goes down in price is bad. Everything is measured by changes in price. And of
Yeah.
course, what you and I have learned, and Scott, being taught by the masters, is the price is not always value. Sometimes it is, sometimes it isn't. You don't know until you actually do the work to figure out what it's worth.
Right.
And once you figure out what it's worth, then you look at the price to figure out, is there an arbitrage there? Should I short it if it's overvalued? Should I buy it if it's undervalued? And when I'll end with this, which is when you explain that to somebody, we understand what the value is. We try to arbitrage the price. They go, yeah, that's exactly right. That's exactly what we're supposed to be doing. And that lasts for about a month or two until the volatility picks up in the market or their monthly statements. And then they all get concerned. And I said, well, don't you remember we had this discussion about price is different than value? And it's very hard. There's only a few, and you probably have this experience, Lauren. There's just a few people in your Rolodex that actually get it. And those
Yes.
are the best clients.
Mm-hmm.
Those are the best clients.
They are the
The
best
rest of them,
clients. They
yeah,
call you up in a downturn. They
absolutely.
understand your
Yeah,
strategy, but it
yeah,
is really hard to vet clients on the front end and
yeah,
even employees because
yeah,
they've all read the books and they all agree with the philosophy that they say it
yeah,
makes so much sense and that they
yeah,
understand it. But when the rubber hits the road, so many
yeah,
lack the temperament to actually put in action the
yeah,
philosophy of value investing. Speaking of value investing and calculating that discount to intrinsic value
yeah.
and valuing a business, will you please walk us through the 3 stages of value investing and the evolution of value investing as you see it?
Yeah. Well, the first two are pretty simple because we had Warren walk us through it. So the very first stage is what I call classic value investing. It was that was identified in security analysis and later in the intelligent investor, which was those things that were thought to be value were low price earnings ratio, low price to book values, and high dividend yields. And if you bought a collection of stocks that had those attributes, you were then considered to be a value investor. And that was Graham, right? But it's interesting when we talk about this in the book too, is that Graham really started with this don't lose philosophy very early in life, because he was really almost financially destroyed twice. Once when his dad had passed away at his young age and his mom had to raise him, and that had a lot of scar tissue for him. And then you might remember that also during the Great Depression and the 1929 stock market crash, he basically was bankrupt there. Had it not been for his teaching job at Columbia University, he probably would have been on Skid Row. So those two experiences shaped his view of investing, that he was going to do this don't lose philosophy. And the don't lose philosophy centered around the low PE, low price to book, high dividend yields, assets. You're buying assets at a big discount. So if everything went bad in the world, you could sell assets.
Yeah, current assets, right?
Yeah,
current
assets.
earnings,
Yeah,
dividends, assets.
and that's how Graham saw the world. And Warren, did the same thing. And when he went to Columbia, studied with David Dodd and Ben Graham. He worked for Ben Graham for a couple of years at the Graham Newman Corporation. When he started the Buffett partnership, for 13 years, he used Graham and Dodd methodology and knocked it out of the park, beat the Dow 13 years in a row. But what happened, and we go to it in the book, is that the stocks that he was buying for Berkshire Hathaway using the Ben Graham methodology. Now, Berkshire Hathaway is a holding company. He's buying private businesses that in his mind would generate cash, the cash of which he could then use to go buy other businesses. In the book, we talk about the penny weighing machine and how you compound that money over time and stuff like that. So that was really central in his mind. But he was buying businesses that were cheap statistically on classic value investing, but weren't generating good cash flows. They were cheap businesses, but they weren't great businesses. And it was Charlie Munger, as you know, Lauren, who made him, or suggested to him when they bought See's Candy in 1972, they should pay a higher price to book, higher price to earnings to get something that gushed a lot of cash. Mm-hmm. And that was the change for Warren. And so from there, he moved on to newspapers. He moved on to Coca-Cola, American Express. He began to buy better businesses that would not have classified themselves as Ben Graham type stocks. And in the 1992 annual report, 20 years after he bought See's Candy, he did finally enumerate what he called the reformation of value investing, which was John Burr Williams. It was all about cash. It had nothing to do with price earnings ratios. He said right there in the 92, it has nothing to do with a high PE or low PE. And as a matter of fact, high PEs of themselves do not mean that you're not getting something for value. It's all about the cash. Mm-hmm. So those are the first two stages. Classic Ben Graham is stage one. Stage two is Warren Buffett going to better businesses. Bill Miller did phase three, which is what he did in the early 90s. And right before I joined him, we started to go to the Santa Fe Institute, which was looking at the study of complex adaptive systems, looking at economies not as physics-based systems, which is modern portfolio theory, but to look at them as biological systems that evolve and adapt. And the lessons we learned there, particularly from some of the scientists, Brian Arthur and others at the Santa Fe Institute, help us understood network economics. And network economics were the new franchises that Warren had talked about. Warren said, the next great money that's going to be made in the world will be people who identify the next franchise. And Bill Miller was the first. He started buying things like Dell Computer and AOL. He was early on Amazon. And, even though we had to get through the 2002, technology boom and bust, he went on to have this phenomenal 15-year track record that was made possible largely because he was able to pivot not only from classic value investing, which how the Value Trust started in 1982, to buying better businesses that worked out in the early 90s. But then Bill was the very first value investor to pivot to technology and just made a killing, just phenomenal. So to be at his side, working with him as he thought about Buffett's, franchise factor as it applied to technology was one of the great experiences of my life.
Yeah, so Bill was really focused on network effects, intangibles, returns on invested capital, and sales growth. So can you just expand on that a bit for my audience?
Yeah, I think, if you and I could ever accomplish something, Scott, you too, if we could ever get people to understand that price earnings ratio has nothing to do with value. But to this day, all the talking heads will basically tell you that, something that has a low PE is a better value than something that has a high PE, which is totally incorrect. It has nothing to do with that. And my friend Michael Mauboussin, I don't know if you know Michael, but
He's
a
at
great
Columbia,
teacher,
right?
writer. Yeah, and he worked with us at Lake Mason, and wonderful teacher. He goes into depths with this with Al Rappaport and others, that it's about cash and return on invested capital. And it is the return on invested capital that is the lever that helps you understand why something with a high PE could be worth more than a low PE. So a low PE stock that doesn't generate a lot of cash and has lousy returns on invested capital, it's probably not worth a lot. But a company that generates tons of cash and earns triple digit returns on invested capital above the cost of capital is worth, a very high multiple without suggesting that you're overpaying for it. So we began to pivot from just looking at cash flow in of itself without also thinking about what the return on invested capital. So as Al Rappaport says, if you earn above the cost of capital, you create value. If you earn below the cost of capital, you destroy value. Then Michael began to expand that to understand, okay, what if you earn 30, 40, 50% return on invested capital? What does that mean relative to a 15% return on invested capital?
Mm-hmm.
And you began to understand that value is worth even more. And then the last piece, as you said, Lauren, sales growth, right? Once you figured out that they earn above the cost of capital, then sales growth becomes the barometer for understanding the growth of intrinsic value. So you're earning 15% return on invested capital and you're growing 15% per year is worth a lot more than a company that earns 15% return on invested capital, but it's only growing 5% per year. Then how is that reflected in the price earnings multiples? So price earnings multiples don't tell you anything about value without you thinking about the cash and the return on capital. That was the insight that we gained at Lake Mason working with Bill.
Yeah, it's fascinating. You've had just an amazing career and to been able to learn from some very interesting people.
Undoubtedly.
Drawing from your book, Investing, The Last Liberal Art, can you say a word about liberal arts educations, or better yet, how your firm encourages interns and analysts to read detective stories?
Yeah, well, the book, I wrote the book. The first edition was written right at 2000, at the beginning of the bear market, which for all of us, Lauren, never put out a book at the beginning of a bear market. It will not sell.
Yeah.
And the original title was called Lattice Work, The New Investing. Lattice Work came from Charlie Munger's Lattice Work of Mental Models, and how Charlie thought about being multidisciplined in his thinking and philosophy and stuff like that. And so we used that title, and the book did nothing, zero. It was a bust. And after the bear market was over, they decided to reissue it in a new title called Investing, the Last Liberal Art, because there were so many liberal arts majors out there. They ripped the hardcover off of Lattice Work and slapped a paperback on it. And the book was a big seller, just because the title changed, and maybe because we're out of a bear market. But it really was, it was written, and the first edition was dedicated to Bill Miller, because he, of all people that I had known, was really someone who really lived a liberal arts interpretation of the world. He did his undergraduate at William and Mary in European history. He was PhD in philosophy at Johns Hopkins, absent the dissertation. He goes to Santa Fe Institute and studies with scientists in biology and physics, and a true multidiscipline type thinker. And so I took those lessons by being able to be with Bill at Santa Fe and what Charlie had said, and pieced together, okay, if you were a liberal arts major in college and you had to take biology, physics, mathematics, philosophy, psychology, sociology, on down the line, literature, what things would you think about and read if you were going to be in the investment world? And one of the things that we talked about was reading investment mysteries, and particularly what we call the great detectives. There were three great detectives, according to the aficionados that know the mystery world. And that was obviously Auguste Dupin, the very first one, from Edgar Allan Poe. The second one was Sherlock Holmes, obviously. And then the third was Father Brown from Gilbert Chesterton. And what was common about them all is that they could solve mysteries by their mental acumen. They wouldn't have to pistol whip a confession or break the law or anything like that. They basically were just deducing, what happened and figuring it out. So we would pass around mystery books at Lake Mason and other places to say, solve the mystery. Because if it's a good mystery, they'll give you all the facts up front. They'll give you all the evidence up front, and it's just up to you to figure it out. And that's kind of what investing is. All the facts are out there. You just got to figure them out.
It really is true. I think a good analyst is much like a detective.
Sure.
So that is very interesting. And I would encourage everybody to pick up a copy of really any of your books, but that one in particular. So where are you currently finding investment opportunities in this market? And how are you thinking about the investing world any differently? Are there any quantum changes to investing philosophy that we should be thinking about that you see coming out of this market right now?
Well, the most mispriced part of the market right now is the growth market. Whether you want, it's the high quality, big tech stuff, the mid cap, small cap. It's interesting. At the end of the pandemic period, as we got to the end of 2020, growth just killed it, right? And it shot it out of the cannon, and the returns were just astronomical. I run a global growth portfolio. Mm-hmm. But I said at the end of 2020, I said, the most mispriced part of the market is no longer the growth market. I mean, it already repriced pretty well in 2020. I said the most mispriced part of the market were the dividend paying stocks, because nobody wanted to own dividend paying stocks because they were afraid during the recession they're going to have to cut dividends. Mm-hmm. Many of the stocks were going to go out of business, blah, 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 blah. So nobody would touch a dividend paying stock, and they were down double digit rates while growth was up, 20, we were up 30 some odd percent that year. But I wasn't banging the table at the end of 2020 saying buy growth. I was saying you should buy the dividend paying stocks. And so over the last, last 18 months, 20 months, what has been the best performing sector of the market have been the value dividend paying stocks. Mm-hmm. Well, now what has happened with the rise of interest rates, the market has become one-sided and, just indiscriminately sells anything with a high PE, anything that's in the growth space, anything that's in the NASDAQ. It's just a one-off sell everything.
Sure.
And growth has now had its worst period. I mean, you could probably go back to the 2000 technology. But mm-hmm. This is the worst period you've ever seen growth. And it doesn't matter. High quality, low quality, big cap, small cap, all of it is being destroyed.
Right.
And there's no doubt in my mind that the quality growth part of the market is the most mispriced part of the market. Now, we're still dealing with some challenges, which are rates are still moving a little bit higher. The dollar is stronger, which affects multinational companies. And then importantly, what you saw today with Google and Microsoft is that we're also in a slowing economy. And so decelerating growth, which happens to, even growth companies, is very hard for the market to figure out. So what has happened now is the growth stocks now are trading at prices at a discount to fair value that I haven't seen in my career. I mean, this has been unbelievable to me. Well,
even going back to early 2000. Yeah.
Yeah. I mean, we're at those levels. I mean, when you can get Google at, less than 20 times earnings, Qualcomm at 11 times earnings, companies like that, these stocks are down 30, 40, 50%. NASDAQ's down over 30 some odd percent. This is what's the most mispriced. And so what we're doing is we're spending a lot of time repositioning the portfolio. We've sold some staples stocks. We own Nestle, Diageo, Unilever, which has Nelson Peltz now on the board, trying to straighten that out. Mm-hmm. Those have done better on a relative basis, but we've taken profits there or taken capital there and reallocated it into software businesses. We think Microsoft looks great, Salesforce, ServiceNow, high PE stocks. But as you well know, Lauren, once again, it's not about PE. Most of these are intangible investing type capital reinvestment that runs through the income statement. So their PEs look unusually high, but in fact, they're building tremendous amount of value. Michael Mobison's written about this. I think, Apple looks great. I've owned it for 8 years since we started the portfolio. 14 of my 25 stocks I've held for 8 years. I haven't sold them.
Yeah.
So, when we find a good business that can compound money at high rates of return, our tendency is to hang on to them.
So you have a 25 stock portfolio? Is that what you said?
25 stocks. Yeah. Our turnover ratio is about,
concentrated.
13% turnover ratio. So, we're holding stocks for quite some time. And if you find something that generates cash, earns above the cost of capital, and sales growth is there, the first thing you want to do is don't sell it. And second, just stay out of its way, because it's going to compound money at very, very high rates of return. Mm-hmm. And that's been the success of the portfolio, set aside that this has been our worst year, both on absolute and relative performance that we've had since inception. So we had beaten the market 3 years in a row and 4 out of 5 and have done very well. But this year, it doesn't matter who you are in the growth space. I mean,
Sure.
It's amazing. James Anderson at Bally Gifford is getting, Dennis
Yeah,
Lynch at
that's right.
Morgan Stanley. Guys are, even T. Rowe Price, which is one of the easiest, plain vanilla growth funds in the world, is down 34% this year. So it doesn't matter who you are. If you own growth,
Yeah.
everybody's down. But now that's the most mispriced part of the market.
Yeah, there are some really bad numbers floating around out there. I do
Yes,
know
there are.
that some stressed out money managers, I think right now. Well, I have
Yeah.
read somewhere, or maybe I heard on a podcast where you talk about, performance over the long term. And one
Yeah.
of the best ways to have great performance is to have a high active share and
Yeah.
low turnover. Is that sort of the theory you're using when you're running
Yeah.
this concentrated portfolio?
Yeah, we wrote a book called The Warren Buffett Portfolio after the Warren Buffett Way, because in the Warren Buffett Way, I only talked about stock selection. I was so nervous about getting the stock selection part right. I didn't really spend any time on portfolio management other than say, Warren owns very few stocks and he holds them for a long period of time. So the portfolio book, which actually was Charlie Munger liked that book. He wasn't a big fan of Warren Buffett Way, but he was a big fan of the portfolio book. We went back and started at square one. And you looked at people like, you go back to the original focus investor, be John Maynard Keynes, who
Mhm.
basically ran money for King's College. He ran a concentrated low turnover portfolio. And then you had Warren, if you look at, the Buffett partnership, low turnover, concentrated. Charlie Munger's partnership, low turnover, concentrated. Look at Sequoia, the very famous Sequoia fund that was run by Bill Ruane and Rick Knuff that came out of the Buffett partnership, concentrated low turnover. You look at Lou Simpson, who ran the portfolio at Geico, low turnover, concentrated. So we had these lineup of people. And then we did some, mathematical stuff, which is taking the S&P 500 and dividing it between portfolios with 100 stocks, 50 stocks, and 25 stocks, and how would they perform over a 10-year period. And the commonality was this: the fewer stocks that you owned on average, the better your long-term performance was. But the aberration was the frequency of which you outperformed relative to underperforming. So everybody except Buffett, killed it 13 years in a row. But everybody else that I had mentioned, the hit rate was about 60-40, which
Mhm.
is on an annual basis, they were outperforming 60% of the time, underperforming 40% of the time. And
Mhm.
so that then became the challenge. And later on, the academicians, Kremers and Petajusto out of Yale University, latched on to this and did the math. In fact, said high active share is how different your portfolio is from the underlying index that you're changed. And then they further then said of the high active share portfolios that performed the best, it was the low turnover. So
Mhm.
we now had the academicians on our side. So we did the theoretical in the beginning, did some kind of weak finance on it, and kind of came to conclusions that we're in the right place. But the academicians, Kremers and Petajusto in particular, and we talked about this in the Money Mind, said, hey, this is how this works. But the problem is, Lauren, how do you explain to a client that your long-term returns are good, but you're only outperforming 50% of the time?
Right.
When people, because, we know from prospect theory and Tversky and Kahneman that the pain of underperforming is twice as,
Sure.
painful as the pleasure of a one unit. So, if you can have a 10-year track record, you underperform half the time, you're going to be more unhappy than you are going to be happy over the 10 years. And so
Yeah.
that's the big challenge. The big challenge is
It is a challenge.
to find people that actually understand business investing, understand concentrated low turnover, understand the difference between price and value. If you find that person, figure out how to replicate them 10,000 times over with, and you have a great business.
Yeah, it's so hard, right? Because even if you understand all of that, I think that you still have to factor in running a business.
Oh, yeah,
And oftentimes in this industry, it's all about gathering assets.
sure,
So you
sure.
really have to get comfortable.
Can I share you a Bill Ruane story?
Yes,
So after
please.
I wrote, yeah, well, Bill Ruane, as it was, he took the same class as Warren did at Columbia, and he started the famous Sequoia Fund. And I met Bill at the annual meeting, one of the first ones, and he said, well, it was at the baseball game. It's when the baseball game was actually on Saturday and the annual meeting was on Monday. And there was Warren Buffett out there with the Omaha Royals pitching out the first pitch. And there was Bill Ruane down the first baseline against the chain link fence. And I went up to him. I said, Mr. Ruane, I'm Robert Hagstrom. Just wanted to introduce myself. And, he's like, Robert, congratulations on the book. I said, no, congratulations on Sequoia Fund. terrific track record. That just this is a pleasure to meet you. And he said, Robert, I'm going to give you a piece of advice. And I said, sure, Mr. Rain, what is it? And he goes, well, you're not going to take my advice. I said, well, Mr. Rain, I promise you, if you give me this advice, I'm going to take it to heart. He said, no, you won't. I said, well, what's the advice? He says, well, you're going to get in the money management business. You figured out Warren Buffett. You figured out the right way to invest. And I said, you're going to tell, 100 people about this, but only about 10 or 15 are actually going to get it. The other 80 will say, yeah, this makes sense, but they're going to end up being a pain in the butt to you.
Yeah.
And I want you to fire them. As soon as they start to complain to you about the way in which you're doing your business, I want you to fire them. And I said, okay. He goes, no, you're not going to do that, because that's how you grow your business. You've got to grow assets under management to have a viable business. So you're going to spend more of your time educating those that are slow to learn than you would be with the pleasure of spending time with people that actually get it, that don't cause you any trouble. And that's the challenge of running business and money management.
Yeah, it's so true. And it's a conversation that Scott and I have almost on a daily basis. It really affects your quality of life too, because
it does.
Usually when you get into this industry, it's because you love researching stocks and you love investing. And sometimes it can feel a bit like babysitting. So you have to, I think, have a real clear vision of, what you're willing to sacrifice AUM and stay a certain size to be able to focus the way you want to focus. It's an interesting conversation. Well, I do want to have a few standard questions that I ask most podcast guests. What are your hobbies outside of investing? Do you have any?
Well, I love reading and writing, so that's pleasurable. And actually, as you get older, it's even more pleasurable. I'm a lousy golfer, but I do enjoy playing golf with my kids and my wife. But there's an old saying that if you're a portfolio manager and have a low handicap, you probably shouldn't put money with them, because they're working on their golf game more than they're working on their portfolio. I love golf. I love traveling. But the best time that I have is picking up a brand new book. And just getting through, trying to figure out what's going on there. I mean, there's so many great books.
Yeah.
The real challenge is, how do you get through them? And it's called intelligent skimming. You just got to get through them. But occasionally you come across a book that, it's become meaningful and can be quite valuable. I love writing. I to this day, I continue to love to write. And so that takes up a great deal of time. And then, obviously you're researching your businesses. And I love this. People keep saying, I'm 66. When are you going to retire? And I said, never. Why would I retire? What else am I going to do? This is what I'm doing, what I love to do. Yeah. And as long as, I can add value, this is the thing that I enjoy doing the most. And reading and writing is part of that conscript, and they work with each other. So it's great.
Sure. John Templeton worked up until, he died. He just continued working because
how old was he when he passed?
He was 95. Is that right, Scott? Or he might have been 95.
Yeah, 95. That's right.
Okay. I sometimes getting confused with my grandfather, his brother, who died at 94. But Uncle John worked until the end. I mean, he was just a very curious person, and he continued learning. He passed in 2008. Okay. That's right, Scott.
Yeah, that's right.
Yeah.
He it actually had a bunch of short positions out around financial firms and some other things tied to the crisis, but unfortunately didn't get to see it.
Sure did. Yeah. It was interesting to learn what was in his portfolios when he passed. And of course, he penned a really famous memo, I think in 2005, called Financial Chaos. Yeah. And the memo started with a line that said, the peak of prosperity is behind us. And it went on to really in great detail describe the financial crisis that would come in the next few years. And so I think he would, enjoy is the wrong word, but I think he would have made some interesting investments in that market. And of course, we think about him in this market, what would he be doing? And it's really hard to tell, because I do think he was such a genius, and he was very nimble in his application of valuation methodologies. And you discussed that too, that what an advantage it is to be flexible, open-minded, and never adopt permanently any valuation method, always looking to improve the methods.
Absolutely. But I'll give you, that just popped in my mind, the commonalities between John Templeton and Warren Buffett was just their belief, and more so with Warren about, the vitality of the United States. But, John Templeton bought all those stocks, in the middle of World War II, right? Wasn't that
Yeah.
the period that he had bought everything that was $1 or less, and he put that to work? And so they both had that commonality that they believed no matter how much the train got off the tracks, it wasn't gonna wreck itself into totality, that they always seem to take those periods. And this looks to me to be a period, just geopolitically speaking, that scares a lot of people. And when you get these geopolitical scares, people are irrational in how they think about potential outcomes. But I always think about Warren, and then I will think about John Templeton, because they made some of their best investments in periods when the geopolitical climate was the worst.
Sure. And Uncle John's investment time horizon was just so incredibly long.
Yeah.
I mean, often I talked to him and he would say, I'm trying to think through the best investment strategy for my foundation going out 200 years. And I'm thinking, that's really unusual that a person is thinking out 200 years and how to position assets. Not many people do that today.
No.
But I will say that Uncle John really greatly admired Warren Buffett. And in fact, one of his sons and a son-in-law were involved in a mutual fund that mimicked Berkshire Hathaway as close as possible.
Yeah.
And then, of course, the B shares came out and there was really no need to do that. But that's because he admired Warren Buffett's investment philosophy so much.
Yeah, I think he had invested in it, Warren. He didn't start it, but they brought the idea and he said, "Oh, that sounds good. I'll invest."
That's right. Yeah. And there were some family members that may have been directors or something like that. So he did admire Warren Buffett. And so there are some similarities there. So this is another question I asked all my guests, because I'm just fascinated with how people in today's market, where there's so much information, there's just a ton of information all the time. How do you organize your day? How do you know what to read, what to study? It sounds like you're reading a ton. How do you do that? What newspapers are you reading? What publications?
Yeah. Well, you do have to read, Lauren and Scott, as you well know. You got to read for information. You have to have the facts at hand, but you can get through that pretty quick. Whether it's the Wall Street, New York Times, Financial Times, whatever the case may be, and you have a Bloomberg here, you can get the daily things. And basically, I've gotten to the point where I can look at a headline and figure out whether I need to spend any time with it or not. So one is, to dismiss as many headlines as you possibly can, as quickly as you can. Mm-hmm. Things that may have relative importance to something that you own, you will stick to. First of all, I don't have TVs on. I think TVs are a huge distraction. Mm-hmm. I see CNBC or Bloomberg or whatever the case may be, and offices, and it's just you just have a tendency to watch too much TV. You got to shut that off. And then, even with emails, it just amazes me how many emails continue to come in, no matter how many times you block them or things like that. And you just got to get through it. You just got to delete, and be to this point. You see something that's relevant, you grab hold of it, but you can get through dismissing 80% of the noise that's coming through your life each day pretty quick. Mm-hmm. And then the rest of the time, you spend, the rest of the day. I try to get through the morning part up until noon, portfolio, company reports, what's going on, stuff like that. And after 12 o'clock, I'm not trading after 12 o'clock usually anyway. Mm-hmm. That's when I start reading and doing things. But by then I've cleaned out the mailbox. By then I already know what the headlines are. By then I've already gone to the headlines on the newspapers, and I'm done. And I try to spend the last 3, 4, 5 hours of the day reading, maybe annual reports or reading books. Always Amazon books are piled high on the desk, and you try to knock out as much you can. And so I spend the day in managing information on the front half, and the back half is trying to get smarter.
Yeah. So what is an interesting book you've read recently that people may not know about?
Yeah, the one book that I'm kind of looking at my shelf over here, the one book that I just got finished reading, it's been brought up again, is Robert Gordon's The Rise and Fall of American Growth. It's trying to solve the mystery of what's happened to productivity growth. I thought that was a very, very important book. I did go through, David Rubenstein's book, How to Invest. He's got some interesting interviews on that. The other book that I read because of all these geopolitics is a book that's been around for a while, Jeffrey Friedman's War and Chance, Assessing Uncertainty in International Politics. That kind of gives you a way of how to think about establishing probabilities and geopolitics and things like that. I like Michael Mauboussin's new book, Expectations Investing, which is, it's the second edition that he wrote with Al Rappaport. And then, in the afternoons, I'm just as easily going to read philosophy books or, psychology books than I am anything specific. So I just got through reading through the Third Critique, Immanuel Kant's Third Critique, The Critique of Power of Judgment, which was a great book. And that's a slow read. That's a slug. You don't want to read that. That's a slog. But, and I like to try to stay diversified. And sometimes I won't read the whole book through, but I'll leave it in a stack and I'll bounce between books just out of curiosity.
Yeah, Scott and I both do that. A lot of bouncing between books. Yeah, so we are the same way. What is your best advice to young people these days, if we have any young people listening?
Yeah.
That's my last question for you.
Okay. I think my advice, and when I talk to college kids and I lecture at universities and things like that, is that, you've worked so hard to get your college degree and you've worked so hard to get your job. Now, don't stop learning. Because a lot of people, I think, once they get the degree and they get the job, they say, I'm done. The people that are really, really good at anything, whether it's investing or, being a doctor, a lawyer and stuff like that, don't stop learning. They don't stop reading. And I think I find too often people in their 20s and 30s, and I'll just say, what are you reading? And they're not reading anything. Or, when's the last thing, So it is like, okay, take the summer off. You got your job, have some fun. And you have a job 40 hours a week, whatever it is that you must cross the T's and dot the I's. But at the same time, don't stop learning. Pick up a book, figure out something. And it becomes a lifelong passion. If you can make it part of your DNA, it becomes a passion. And I Charlie Munger said, I've never known anybody who wasn't successful in life that didn't read a lot. And reading has fallen out of favor. I mean, with internet and emails and YouTube and stuff like that. And, I do all that stuff too, but you've got to continue to educate yourself. If not, there's no way in 10 years you're going to be up on the curve. Sure. You'll be behind. Yeah. And so my advice is, don't stop learning.
It's a great advice. Be lifelong learners. And there you have it. Robert, I really appreciate your time today.
It was a lot of fun, Lauren. Thank you.
Thank you for listening to Investing the Templeton Way. Please be sure to subscribe on your favorite podcast player. To view the show notes and resources mentioned in today's show, head to investingthetempletonway.com.